August 5, 2024. Tokyo opens like any other morning, polished floors, disciplined voices, the quiet religion of numbers. And then the floor gives way. The Nikkei drops roughly 12% in a single session, a fall that, in speed and violence, evokes the old panic chapters more than the modern ones. And by the time New York takes the baton, the S&P 500 doesn't crash. It does something more revealing. It shudders like a building feeling a tremor from a fault line that hasn't reached the surface yet. People blame headlines, elections, earnings, sentiment. But the market does not run on sentiment. It runs on plumbing. And the dirty secret of the past few years is this. Some of the liquidity feeding the American AI boom, the private credit boom, even the stubborn resilience of risk assets, is not purely American money. At the margin, it is borrowed Japanese yen. Cheap currency, cheap leverage, a credit line issued by a country that spent decades whispering near-zero interest rates into the global system. And now, that country is clearing its throat. Over the last 2 years, traders have watched an awkward relationship repeat itself. When the yen is weak, U.S. stocks often levitate. When the yen strengthens, U.S. risk assets often tighten their grip and start to slip. It's not a perfect mirror. Nothing in markets ever is. But it rhymes often enough to make a sober person uncomfortable. So ask yourself quietly, without drama. If funding for your American bull market is denominated in yen, who is actually holding the leash? Most analysts keep their eyes on the Federal Reserve, as if the Fed is the only lighthouse in a storm. But there is another light, colder and farther, coming from Tokyo. There is a specific yield level in Japan that matters more than 100 American headlines, because if it is breached, incentives flip. And when incentives flip in leveraged systems, selling is not a choice, it is an obligation. To understand why, you have to understand the trade that sits beneath the surface, like a submerged engine keeping the ship moving. The yen carry trade. Japan spent decades in a world of near zero, and at times negative, interest rates. While the rest of the developed world argued about growth and inflation, Japan became something else, the supplier of cheap oxygen. If you are a global investor and you can borrow at close to nothing in one currency and invest at meaningfully higher yields in another, you don't need genius, you need scale. The carry trade works like this. You borrow yen at a very low cost, you convert yen into dollars, you buy higher-yielding assets. U.S. Treasuries, investment-grade credit, high-yield credit, and yes, the equities everyone can name: Apple, Microsoft, Nvidia, the broad SB. You collect the spread, and you assume the currency doesn't move against you. That last part is where the fable turns into a crime scene, because in carry trades the real killer is not the interest rate alone. It is the currency move. If you borrow yen and the yen rises, your debt becomes heavier in your functional currency. You are running uphill, and someone is quietly adding plates to your backpack. The Bank for International Settlements, the BIS, tracks cross-border lending and currency exposures, the bloodstream of the system. And their data has long shown persistent foreign currency positions funded in low-yield currencies, including yen. The exact size of the yen carry trade is debated, because leverage hides in derivatives, swaps, and off-balance sheet structures. But estimates commonly range from around $4 trillion to as high as $20 trillion when you include broader carry-like exposure across markets. The range is wide because the system is deliberately opaque. But even the low end is not small and the high end is existential. If you want a simple analogy, imagine you have a credit card with a 0% rate, no limit, and no questions asked. You pull out $1 million in cash. You place it into an account paying 5%. You earn $50,000 a year for doing nothing. That's the carry trade in its cleanest, most seductive form. Now ask the only question that matters. What happens when the credit card company raises the rate to 6%? Or when the currency you borrowed strengthens, so the debt swells even if you never spend another dollar? You might think, I don't own Japanese stocks, I don't care. But the modern portfolio, the retirement account, the index fund, they sit downstream of global funding conditions. When the plumbing tightens, diversification starts to behave like a polite myth. In a liquidity event, correlations rise. And then often they converge, as if the whole market becomes one animal trying to fit through a door that is suddenly too small. Look at what that means in plain language. If leveraged players need to reduce risk quickly, They don't sell what they dislike, they sell what they can. Liquidity becomes the executioner. The most liquid assets, U.S. index futures, megacap tech, treasuries, become the first things thrown overboard, not because they are the worst, but because they are the easiest to sell in size. And this is not the first time the ghost has walked. In 1998, the yen surged violently. USD JPY fell from the high 140s toward the mid-110s in a matter of weeks. That move did not merely affect exports. It detonated leverage strategies built on the assumption that currency volatility would remain tame. Long-term capital management, LTCM, collapsed in that environment, a hedge fund staffed with elite credentials and exquisite mathematics, discovering too late that models do not control crowds. In 2008, the same pattern wore a different mask. Mortgage leverage, repo funding, a global dash for dollars. Different collateral, same ending. When lenders demand margin, you sell what is liquid, you sell what clears, you sell what keeps you alive for one more day. That is the ghost, the global margin call. The moment everyone learns the same lesson at once, and the lesson is paid for with forced selling. But this time, the scale and structure are different in one crucial way. In 1998, it was a hedge fund problem. In 2008, it was a banking problem. Today, it is creeping towards sovereign scale. Japan's central bank, the Bank of Japan, has spent years buying its own government bonds under a policy called yield curve control, YCC, an explicit attempt to cap long-term interest rates by promising to purchase bonds in whatever quantity is required. Over time, this turned the BOJ into an outsized holder of its own bond market. Depending on the measure and period, widely tracked estimates put the BOJ at roughly half of the Japanese government bond market, a concentration reflected in BOJ releases and followed closely by major financial data services. A market is not made safer when one buyer becomes dominant, it becomes thinner. The exit becomes narrower, precisely when the crowd becomes larger. So consider the question that polite finance avoids. In 1998, the Fed could coordinate a rescue of a hedge fund. In 2008, it could backstop banks. But who bails out the central banks when the stress travels through exchange rates and sovereign bond markets? When the problem is not one institution, but a global incentive structure snapping back. The Federal Reserve cannot print yen. The Fed does not vote in BOJ meetings. And in an FX-driven unwind, the Fed can provide dollars. But it cannot prevent the yen from strengthening if Japan's yield structure and capital flows demand it. Now we reach the pincer movement. The part that turns discomfort into crisis. The carry trade lives on a spread, a differential, the gap between what you pay to borrow and what you earn by investing. In simplest form, the spread equals the U.S. rate minus the Japanese rate. When U.S. rates are higher and Japan's are pinned near zero, the spread is wide and the carry trade looks like a quiet machine that prints money. But what happens when the blades close? If the Fed begins cutting or markets pricing cuts, U.S. yields drift down. If the BOJ allows Japanese yields to rise or signals normalization, Japanese yields drift up. The spread narrows. The incentive shrinks. And then the currency move becomes lethal. Because the carry trader is not just earning a spread, the carry trader is short yen. If the yen strengthens, the trade bleeds from two wounds at once. This is why watching only the Fed is a professional mistake. You are watching one blade. The second blade is in Tokyo, moving with the slow certainty of demographics, inflation pressures, and political limits on endless monetary suppression. Now, the yield level that matters. Not because it is mystical, but because it is where incentives flip for large pools of capital. Japanese institutions, especially life insurers and pension allocators, have been among the largest holders of foreign bonds for years. They were pushed outward by domestic starvation. Low yields at home forced them to search abroad. They bought U.S. treasuries, U.S. credit, and other foreign assets, often with currency hedges that themselves have costs that change with interest rate differentials. But at a certain point, Japan becomes competitive again. Not emotionally, mechanically. When domestic yields rise enough, the choice stops being reach abroad or earn nothing, and becomes earn enough at home with no currency risk. Market participants often discuss a zone around 15% to 20% on the 10-year Japanese government bond, as a region where domestic fixed income becomes meaningfully investable at scale for institutions that previously had to export capital. The exact trigger varies by institution, liabilities, hedging costs, and regulatory constraints, but the principle is stable. Above a certain domestic yield threshold, repatriation becomes rational. Repatriation is not a slogan. It is an action, selling foreign assets, often U.S. Treasuries and U.S. credit, to buy Japanese bonds. Now imagine the chain reaction, step by step, without melodrama, just mechanics. The BOJ allows higher yields or loosens the constraints of YCC. JGB yields rise. The yen strengthens, meaning USD JPY drops. A level like 140 becomes a psychological and technical stress point because many strategies and risk models cluster around round numbers and established ranges. As the yen strengthens, carry traders take losses on the currency leg. And as the spread narrows, the income cushion disappears. Risk models update. Margin requirements rise. Prime brokers make calls that are not requests. Algos and risk parity systems de-risk into falling liquidity. Selling U.S. equities, selling tech, selling credit, and sometimes selling treasuries to meet funding needs. At the same time, if Japanese institutions reduce foreign bond exposure, that removes a marginal source of demand for U.S. treasuries. And in a market that must continuously absorb new supply, marginal demand matters. U.S. Treasury yields can spike in such moments, not because America suddenly became unsafe, but because the buyer base changes and the market demands a higher yield to clear. Higher yields then pressure equity valuation, especially long-duration growth stocks, because future cash flows are discounted at higher rates. Volatility rises, and volatility is a tax on leverage. Pause and consider what that means. The danger is not that Japan crashes America as a narrative. The danger is that the same trade is on too many balance sheets, and when it unwinds together. Synchronization is what turns an orderly exit into a stampede. So define the kill zone with honesty. If the 10-year JGB yield sustains a break higher and begins marching toward the region where domestic alternatives become compelling, the probability of meaningful repatriation rises. That does not mean a $20 trillion sell-off arrives overnight. It means the upper bound estimates stop being academic and start becoming positions that must be reduced because the incentive that created them is gone. When a great unwind begins, investors learn a cruel rule. In a liquidity event, correlations go to 1. The lights go out in a library. The books are still there. But the system that let you browse calmly, credit lines, repo, FX swaps, cross-currency basis, stops behaving like infrastructure and starts behaving like a trapdoor. So what do you do if you are not a hedge fund, not a bank, not a policy committee, just a person trying to survive a system built for someone else? First, reduce leverage. This is not a market to be on margin unless your job is to manage margin risk. Forced selling is what turns a drawdown into a permanent loss. And the market does not care if your thesis was correct. It only cares if you can meet collateral calls. Second, understand the hierarchy of collateral and the difference between assets and liabilities. In a crisis, the system worships what can settle. That usually means short-duration government paper, cash equivalents, and high-quality collateral, not because they are exciting but because they are accepted. Short-duration treasury bills can function as dry powder, a position that does not collapse when liquidity thins and that can be deployed later when good assets are mispriced by panic. Third, consider hard assets but with realistic expectations. Gold is not magic. It is simply counterparty-free money, a bearer asset that does not depend on someone else's promise to pay. In some liquidity crunches, gold can dip initially as people sell what they can to raise cash. But historically, during extended currency stress and policy response, gold has often recovered as central banks respond with new liquidity, new facilities, new forms of quiet debasement. And if you want to speak about who wins and who loses, do it without romance. This is the Cantillon effect. New money and cheap funding benefit those closest to issuance, large institutions, levered funds, entities with direct access to balance sheet and privileged financing, before prices adjust. When the cycle turns, the costs travel outward. The public receives the inflation late, and the instability later still. Now, there is a subtler point that most doom narratives miss. Repatriation does not only destroy, it reallocates. There is an asset class that can benefit specifically from Japanese capital coming home. Not Bitcoin, not American real estate. Often it is Japanese domestic value equities, particularly sectors like banks and insurers, which can improve as yield curves steepen and domestic spreads normalize. This is not a blanket recommendation. It is a map of incentives. When domestic yields rise, the financial sector can regain something it has lacked for years: oxygen. The question then is not, will the world end? The question is colder. Are you positioned for the world you want or the world the funding market is building for you? Now we close the file with 3 things to watch, because analysis without monitoring is just literature. First, USD/JPY. Watch the 140 region as a stress barometer. Not as prophecy, but as a gauge of whether yen's strength is accelerating and whether the carry trade is feeling pressure. Second, the 10-year JGB yield. Watch whether it breaks and holds above roughly 11% to 12% as an early warning of regime drift. And watch whether it begins advancing toward the region where incentive flips become more plausible, the area often discussed around 1.5% and beyond. Third, Bank of Japan communication on yield curve control. Any hint of tolerance for higher yields, reduced bond buying, or policy normalization is not local news. It is global collateral news. The U.S. market, especially at the index level, is not just a story of American earnings. It is also a story of global funding conditions. And for decades, Japan has been a quiet exporter of cheap capital. If that era ends, the repricing won't be polite, it will be mathematical. The system isn't broken, it's correcting. And the correction always returns to the mean. Stay liquid, stay watching. I'll see you in the next file.